You've probably heard the old investing rule, right? Buy cheap. It's pretty much the foundation of value investing. But what if I told you that one of the greatest investors ever, Warren Buffett, made one of his absolute best deals by paying a price that looked, well, completely outrageous? Today, we're going to unpack the incredible story of See's Candies to figure out how paying a higher price can sometimes be the cheaper option. All right, here's our game plan. We'll start with the classic playbook, then see how Buffett totally flipped the script. We'll use a really simple analogy, 2 coffee shops, to break down his logic, uncover the secret called economic goodwill, talk about the one massive catch you have to watch out for, and then wrap it all up with a brand new way to look at value. So the classic idea of value investing, the one made famous by Benjamin Graham, is super simple and powerful. Buy a business for less than it's actually worth. But, how do you even figure out what it's worth? Well, one of the go-to tools for a long time was the price-to-book ratio, or PB. Just think of it like this. Book value is what's left over if a company sold everything it owns, all its factories, machines, inventory, and then paid off all its debts. The PB ratio just tells you how much you're paying for that pile of assets. And for decades, the golden rule was simple. Find companies with a PB ratio under 1. That was the game. It was like buying $1 for 50 cents. You were literally paying less for the company than its physical assets were worth on paper. It feels like a total no-brainer, a can't-lose situation, right? But then came Warren Buffett's investment in See's Candies. And this deal just seemed to fly in the face of everything his mentor, the great Benjamin Graham, had ever taught him. Buffett paid 3 times the company's book value. Now, according to the old rules, this was just nuts. He wasn't buying $1 for 50 cents. He was paying $3 whole for just $1 worth of physical stuff. So that's the big question, isn't it? What on earth did Buffett see that this simple price-to-book ratio was completely missing? Why did he think this was a total bargain when it looked so ridiculously expensive on the surface? To really get our heads around his logic, let's break it down with a simple analogy. Let's call it a tale of 2 shops. Okay, so picture 2 coffee shops right next to each other. Here's the key. They are equally profitable. Both of them bring in exactly $10 of profit every single year. But these shops are totally different. Shop A is the Palace. It's what we'd call an asset-heavy business. It's got marble countertops, gleaming top-of-the-line espresso machines, the whole 9 yards. Shop B we'll call the Recipe. It's asset-light, just a few simple tables, a basic coffee maker, but it has this beloved secret coffee recipe that people will line up around the block for. So because of all that fancy equipment, the book value, the value of all its physical stuff for Shop A, the Palace, is $100. Shop B, on the other hand, barely has any physical assets. Its book value is just $10. All right, so here's the choice for you, the investor. You can buy Shop A for $100, which is a price-to-book ratio of exactly 1. Or you can buy Shop B for $30, which is a price-to-book of 3. Now, if you're following the old rule, Shop A looks like the obvious, safer bargain, doesn't it? But this is where the whole story just flips on its head. Look at the return on equity, the ROE. Shop A needs $100 in assets to make $10 of profit. That's a 10% return. Shop B, though, makes that same $10 profit with only $10 of assets. That is a staggering 100% return. And what this means is, when you look at what you're paying for the profits, the price-to-earnings ratio, you're only paying 3 times earnings for Shop B, but you're paying 10 times earnings for Shop A. Suddenly, the expensive shop is actually the dirt cheap one. This is the exact logic that Buffett saw in See's Candies. He was looking at a hidden asset, something that just doesn't show up in the book value, and he called it economic goodwill. So what is economic goodwill? It's that invisible value that comes from a powerful brand, a stellar reputation, or, a secret recipe. It's the ability to generate amazing profits without having to own a ton of expensive stuff. For See's, it was the love and nostalgia that customers felt for their chocolates. You just can't put that on a balance sheet. And this is when Buffett realized something crucial. The very best businesses are the ones like Shop B. They don't need a constant fire hose of cash just to be able to grow. And that, right there, is where the real magic happens. Just think about growth for a second. For Shop A, the Palace, to double its profits, it probably needs to build another $100 palace. It's what you'd call a capital black hole. But what does Shop B have to do? It doesn't need a new factory. It can just leverage its powerful brand, its secret recipe, and maybe raise the price of a cup of coffee by 5%. Its growth is practically free. Okay, but here's a really important warning. This does not mean you should just run out and buy every single company with a high PB ratio. There is a huge catch. I mean, that incredible 100% return on equity that Shop B is enjoying, that's going to attract a lot of attention, a lot of competition. So what stops another coffee shop from opening right next door and just stealing all those amazing profits? The answer is something Buffett calls a moat. A moat is just a durable competitive advantage that is really, really hard to copy. For Shop B, it's that secret recipe. For See's Candies, it's a brand that has been trusted and loved for generations. Without a strong moat protecting that business, trust me, those high returns will get competed away in a heartbeat. So at the end of the day, the See's Candy story really teaches us to look past the simple, surface-level accounting numbers and see the true economic reality of a business. And this gives us a whole new framework for how to analyze a company. First, don't get obsessed with a high PB ratio. Second, dig into the return on equity. How powerful is the company's profit engine really? Third, ask yourself, does this engine need a ton of capital just to keep growing? And finally, and this is the most important part, you have to confirm that the entire operation is protected by a deep, wide moat. You know, this way of thinking is probably more relevant today than it's ever been, especially in an economy that's dominated by brands and software and networks. And it leaves us with a really fascinating question to think about. Which businesses around you right now are just like See's Candies, hiding their incredible earning power and their true value far, far away from the balance sheet?